So the next thing to talk about is stacked imbalances. Now, most people are familiar with stacked imbalances, okay? And so this is like nothing new to a lot of people. And it's when three or more buying imbalances are stacked neatly on top of each other, or when three or more selling imbalances are stacked neatly on top of each other. But they have to be stacked neatly on top of each other, okay? So for example here, okay, this is a stacked selling imbalance, right? You got 1, 2, 3. They're stacked nice and neat on top of each other, okay? I don't think there was any buying imbalances on this 10 years. That's what a stacked selling imbalance looks like. And now there's different ways you can use it, right? You can draw out on the software when you have a stacked buying imbalance or stacked selling imbalance, you can draw out this zone, okay? You got two choices. There's it here. You can do fixed or until tested, okay? Fixed is if you have it fixed, you have this size here. You can draw it out 5, you can draw it out 10, okay? But if you have until tested, it will show up there until the market comes back there. Then it'll stop drawing once the market pulls back to that level of that stacked imbalance, okay? Now you could adjust the level of the imbalances, and it's all right in here, imbalance trigger in percent. So if you don't want to use 400%, say you want to use 300%, 3 to 1, you can change it to 300, okay? But 400 is fine for most people. I know some people that use 300. I know people that use 10 to 1, 1,000. Now, depending on the market, say you're trading NASDAQ or something, right? 3 is nothing in the NASDAQ. 3 levels, right? 1, 2, 3. Maybe you want to make it 5. Look for levels for stacked imbalances where there's 5 levels of imbalances stacked on each other. But for most people, the starting point is 3 and 400, right? 3 levels at 4 to 1. Okay. Now, crude oil. Okay. Where are we? What day is this? This is yesterday. Now, just show you these imbalances. So I have the imbalances on. Stacked imbalances. What do I have on here? Just check it. Okay, until tested, 400 and 3. Okay. But I'll just show you what it looks like, right? So until tested here, right? This is 64.87 to 64.89, right? I don't think it came back there, but yeah, it didn't. Crude oil. I think we're in for a sticker shock this summer with crude oil. But let's just go back to the day before. Okay, so you can see these levels right here. What was that level? 60.40. Okay, so here, right? You have this level here, 60.45, right? So 60.40 to 60.45, right? You got this nice stacked imbalance in here. Boom, boom, boom. Okay, market goes higher, spending all this time well above that level. Now, obviously, it came back during this number, traded through. You can see did it hold? Obviously you got that knee-jerk reaction, but generally when you're trading, using these things as tested, until tested, right? You're basically going to be drawing out these lines, right? You want to know how the market is going to react when you get back to it, because there are times where the market comes back to these levels and the market holds beautifully, okay? Right, this one just went right through. What was that other level here? That was the 40. Oh, this one here, 97 to 93. If it came back here that day. No. But you're looking for these levels to be tested again, right? Here's the S&Ps. Here tested that level yesterday. Okay, these are sweeps, which I'll get to in a minute. But you can see these. Where's these imbalances? Here's an imbalance is running from way, way back there, right? It came back. Now, obviously, we spent a lot of time above, came back down towards that level, and it's testing it, right? Sure, it violated 32 just down to what, 28 and a half. Okay, considering that, we sold off from 72 all the way down, a 40-point move, don't always expect it to stop right at that level, right? Okay, you could work a bid in here, in the micros, 32, right? You put in a 4-point stop, 5-point stop, all right? Because, if it bounces off that, and it moves, just retraces back half of that 40-point move, that's 20 points, you're risking 5 points. Okay, that's, what is that? 4 to 1, 5 to 1. Okay, so that's stacked imbalances. So the next thing I'll talk about is multiple imbalances, all right? And this is something that not a lot of traders pay attention to. Okay, multiple imbalances are important, very important in my mind. And multiple imbalances, okay? When you're looking at a bar, right, there could be more than 3 imbalances, either buying or selling, and they're not stacked on top of each other. Does that mean that those imbalances are not important? No, right? They're still important, right? Yeah, we like to see things stacked neatly in order, but the market's messy at times, right? You get these imbalances that are spread out. That doesn't mean that, well, they're not stacked on each other. These imbalances are useless, right? That's not true. Okay, so in here, under volume imbalances in here, you can see multiple imbalance bar outline. It's set to violet, and it's going to look for a 3. Again, you could look, you could use 5 if you're trading something like NASDAQ or something, or MNQ, or even Dow, something a bit volatile, DAX, but 3 is good enough for most people. Now, again, it's the imbalances are related to this setting here. So if you're going to use, if you're using 300 as your imbalance threshold, whatever you're using for multiple imbalances as well as stacked imbalances is set to 300. We don't have it separated, it's connected there, okay? And really what you're looking for is imbalances. Ideally, the point is not to trade every single bar with multiple imbalances, right? Take it in context with what's happening in the market, right? Are you at a swing high or are you at a swing low? Let me just remove those lines. So for example, yesterday, right? Yesterday was, kind of a hectic day in the markets, okay? So look at this, right? We're selling off here. We sort of get to the swing low, right? We just sold off, from the 90s all the way down into the 60s, a 30-point move. Okay, now you're starting to see some bullish activity, right? Obviously the delta is positive, it's 1969. The max delta is 1970. So you close within one contract of your max delta. That's bullish. The min delta is 0. Okay, there was at no point were the aggressive sellers in control of this bar. Obviously you got the 0 prints, but look at this, it's got a box around it. It's got that violet box. It's telling you that there are multiple buying imbalances in the bar. Okay, you see there's 1, 2, 3, 4, 5, 6 imbalances. Right, so imagine you just sold off 30 points. You got a 0 print. You got nice positive delta. The max min delta relationship is bullish. You got multiple imbalances. Right, all you gotta wait for is just the next bar to start showing you some bullish activity, and it does. It starts trading higher. You get long up in here at 72, 72 and a half, 73 even. It pulls back a little bit, 69. Okay, but look what happens, right? It rallies from 72, all the way back up to the 90s, right? Get up to the 90s, what do you see? You see a bar with multiple selling imbalances, right? Then another bar with multiple selling imbalances. As you get right up towards the swing high, you start coming off, you got price exhaustion, right? You got that little single print up here. It's a little hard to see. Right up here, one lot, right? You got a bearish ratio. I'll talk about ratios later. And the market sells off. Crude oil, again, whoops, take off these lines here. Again, I'm not looking to trade every single bar with multiple imbalances. Where's it going? What do you think is going to be effective? When you're making new highs, you want to see bars with multiple buying imbalances. That's normal, right? You want to see that aggressive selling. But if we, get to, a swing high or, a swing low, and I start seeing multiple selling imbalances coming in at a swing high or multiple buying imbalance. Let me get to the day session here. Multiple selling imbalances, at a swing low, that's where I'm ready to, take action right here. We got a little move up. That's not multiple. Here you get this high, right? Yeah, I would take this trade, but then, obviously you got to watch what's happening in the order flow, right? It starts to move down. Okay, but then just stops, goes sideways on you. Fine, the trade didn't work out. You're not going to sit here and get short here, hold it for 1, 2, 3, 4, 5, 6, 7 bars before you get stopped out. If it's not working immediately, that's your time to get out. You don't have to sit there and wait till the market stops you out. Um, you know, Again, I find it, trading in context. Now we're coming up on the close of the day. That was the 4th. Let's go back to Friday, more recent. Your high of the day, you got your divergence. 2 bars later, you got your exhaustion in here. You've got 1, 2, 3, 4 imbalances, right? As the market sold off. Look at 10 years. Again, obviously you got multiple imbalances in there. I don't think you're going to see many in the 10 years, honestly. You might, but unless there's like a number that came out. But if you see it, in a market like the 10 years, here's one. This was a stacked imbalance. But if you look at a market like bonds, even, here's a stacked imbalance. Let's take a look at bonds. Honestly, trading 10 years, it takes a certain mindset. You've got to be patient because it moves very slow at times. And it just trades lots of volume. But if you're looking at, other markets, so this is the bonds, if you change it, this is a 4 range chart, and trying to get 4 range chart, you've got 1, 2, 3, 4, 5 price levels, right? So seeing, 3 imbalances on a 4 range chart sometimes can be a stretch. So if you're using something like a 4 range chart or a 5 range chart, maybe you want to set it, on certain markets. I'll show you, right? You could adjust it to a smaller level, right? This is set to 2. So it's going to show me bars that have 2, right? Here's 2 selling imbalances. There's 2 here. Obviously, this is, 2, But again, it depends on the market that you're trading. I think I got gold up here. Gold, let's take a look here. As this market's moving up, you want to see imbalances, right? As the market comes into a swing low, right? You want to see buying imbalances. But again, it's a tool you could use to form your own trading strategy around, right? It's not about just taking every single selling stack, multiple selling imbalances, right? Like here, or or here. Take them in context of the market, right? Because really, that's what you want to do. Now, the next part of imbalances is the inverse imbalance, okay? And this is something that's not going to show up necessarily in a lot of bars. Now, an inverse imbalance occurs when there are trapped traders in the market. And let's see, you can see more on certain markets like gold or Nasdaq or MNQ. Markets that are a bit more volatile, you'll tend to see it. Make sure I got it turned on here. Okay, so inverse imbalance is in here under the volume imbalance. There's right here. So it's going to be blue for bullish or red. Now it's going to, if you have a stacked imbalance, it's going to draw it over the color because it's, in my mind, it's a stronger tool. Okay, basically. But again, it's not something that's going to necessarily appear in all markets every day, and it's really designed for the more volatile markets, because those are the markets that tend to move around a lot quicker, right? And you're going to see people getting stuck in positions more. Come on, Ninja Trader. But again, there's not many examples in the gold. All right, I'll tell you what I'm going to do. I will open up M&Q or just NQ. And I'm not going to use a minute chart. Let's use a 30-second chart. Just give it a second to come up here. Let's see if there's any in the E-minis here. But really, this is a tool like right here. Okay, this is an inverse imbalance. Right, when you see that, right, it's red. You want to be short, right? If it's red, right? Obviously, this is when the number came out. What happened? You got that knee-jerk reaction. You got all these people trapped up here, right? This is inverse imbalance. It's a stack buying imbalance in a red bar. And you got to be wondering, why is there a stack buying imbalance in a red bar? Well, it's because people, the number came out, people thought, hey, I'm going to be smart. I'm going to jump in front. They started buying it, right? That's how you got that inverse imbalance there. I don't think there was anything the night before. But let's just take a look here. Again, I didn't create slides for all this stuff because I just want to show you it in the market, what it looks like, right? Because rather than, pick this slide, pick that slide, that's nice. But, at the end of the day, you got to trade as the market is unfolding before you. Here's an inverse imbalance, right? You got that red, it's a buying imbalance, right? But it's showing you as red because what's happened is, market was going up, and then it's just sort of hanging around here. People got aggressive, right? People got interested in taking this market higher. It left that imbalance in there, that inverse imbalance, and what happened? The bottom dropped off, right? These guys realized they were stuck and sold off, right? The market came back up. Where'd it come back up to? That area that they were, and then the market sold off. But let's see if I could find a buy in here. Buy would be blue color. Again, in a market like E-minis, during the day session, you're really not going to get a lot just because it trades so much volume. Now look at this, okay? So I don't want to, I just want to go back to this level here, right? This 38.22, okay? When this was an imbalance from way back here. Right here. Okay, look at that imbalance here. 38.22, right? That stacked imbalance. Again, this is why, we talk about these zones being drawn out, right? 38.22 trades all the way down, obviously, sold off, way down into the 3700s. And then we came back, right? Came back, Look at that. Came right up to it. That was the high of the day. That was at 740, right? This was on the 4th, which is what, Thursday. Trade one tick into it. You got the divergence, and the market started selling off a bit from there. But anyway, that's that. But let me go look at NASDAQ for an inverse imbalance of buy. Again, that's why if you're drawing out those zones, until tested, it's always amazing to see. Sometimes they just literally come back to that particular level. Again, this is a 30-second NASDAQ chart, which moves pretty fast. But what I can do, I could adjust it a little bit, but I want to find a good example of a buy for you. Honestly, the way the market's been the last couple of days, trying to buy things is kind of hard. So here's a bearish inverse imbalance right there. But I really want to find a bullish one. Yeah, could be that it's set too tight. Sometimes, like I said, other people, sometimes they use different levels, 4 to 1. is sort of the industry standard. But if you used, I'll turn off stacked imbalance for now. You could use 2 to 1. You could use 300%, 3 to 1, right? So again, I'm just showing you this for example purposes. The whole point of using order flow is to get you to think about what matters to you in your analysis in the market. So I'm going to use box size of 2 imbalances. I think it's going to be 2, and it's going to be set to 3 to 1. Okay, so there's obviously going to be more opportunities for it to come up on. So just bear with it here for a second. Let's take a look at crude. This is the crude markets. Let's go back through the crude real quick. Again, if you're using the 4 to 1, you're not going to get a lot. But if you want, I like to look at inverse imbalances when they occur. Yeah, so even in crude, because markets that trade a lot of volume, you're not going to get a lot of inverse imbalances unless there's like a number that came out that caused the inverse imbalance to happen. That's still coming up. Takes a while because NASDAQ's just got a ton of data it's got to load. Now, again, you see me flipping through charts, right? And here's another long-term stacked imbalance, right? What did it do? It came right up to that level and then dropped 20 ticks. But you see, I'm just right now, I really want to focus on these inverse imbalances. Just give it a second here. So, here was a buy one here. Again, it's set to, this time it's set to 2 imbalances at 300 to 1. Let me expand it here just so you can see right in here. So it's a weaker signal because the imbalance levels threshold is set lower, and it's just looking for 2, right? Really what you want is nice, strong imbalances. Again, here's one here. But again, you got to have the order flow telling you which way to go. In this case, this is a bullish one because it's coming over here, but this bar, right, it's hard to read the order flow in this bar because that's the problem with NASDAQ. It just covers so much ground very quick, right? This is the imbalance, all right? But the next bar opens up below it. That's not the type of trade you want to take, right? You want to be trading up here, right? Finally, we break up here and go higher, but this one obviously is when the cash opened. You don't want to be getting short, like here's one here, here's one here. You want to be getting short below this level, not above it. All right, just as you want to be getting long above this level, not below it. That's what you're doing when you're dealing with imbalances. Is you want to be going in the direction of the imbalance. You don't want to be fighting that imbalance, right? Here, right? There was your imbalance, right? Then the market started going higher. This is your inverse imbalance. It's blue, it's bullish, right? So you want to be trading above it, not below it. Again, another blue one, right? You want to be trading above it. You don't want to be getting long below a bullish inverse imbalance. You want to be trading above it. Anymore. Again, this is the night session. Again, here, right? You got your bullish one here, but we opened up below it, right? That's not the trade you want to take. Eventually, it did trade higher. And you got a selling one, which sort of canceled each other out. Bullish one, it was above it. Then once it starts coming back towards it, obviously that's not the trade you want. It's bearish one, but we're trading above it. You don't want to be getting short from above the imbalance, right? You want to be getting short from below the selling imbalance, right? Here, boom. Now again, NASDAQ is a different beast altogether. It's not for every trader. I don't recommend new traders trade NASDAQ. Basically, it moves too fast for them, and then they get frustrated. Now, unfinished business. Now, this is an old thing. Unfinished business has been around for a long time in order flow, and it's really better for normal market conditions. Now we're not in normal market conditions. Markets got a lot of volatility. It's really for range days, days that you're in a trading range when you're looking for price to come back to that level. Now, basically, in unfinished business, it shows the areas where the buying and selling don't complete in the sense of a bar forming as it should. So, meaning there should be a closed auction at the top or of the bar or the bottom of a bar, okay? And you don't always get those, okay? Now, again, under the current market conditions, I don't think it's useful anymore because we're just too volatile in these markets. But again, people, they go on the internet and they read about unfinished business and they think it's, a great thing. But honestly, it's meant for certain market conditions, okay? And I've talked to traders that have been using order flows, since or using other trading software, watching, the footprint chart, going back to the early 2000s, and they're telling me, when they first developed, I don't say developed, but when they first sort of noticed what unfinished business was, the market conditions were completely different, and they would look for the market to come back to those levels, relatively soon, like within 30 minutes to an hour. Now people want to carry these levels for a long time, but I'll just show you what it looks like here on the chart. Again, I don't use them. They're there because, obviously when we developed the software, it was an effective way to see things. But honestly, the way this market is now, there's just too much volatility going on in the market to really, in my opinion, the way I've always used unfinished business. Now, again, just because I use unfinished business in one way doesn't mean that that's the only way you could use it. Everyone's got their own ways of using unfinished business, and not their own ways, but they may have wrapped it up with another form of market analysis. But here, I'll just add it on a couple of charts here so you can just sort of see. Now, there's two settings actually with it when you enable it, and I can't spell here. Unfinished business. There's, you can see detect unfinished business and draw broken levels. If you have just detect unfinished business, it's going to find the most recent ones. So and then it's going to undraw the ones that were there earlier. But if you have detect broken levels, it'll show all the levels. Okay, because if you have just detect unfinished business, it's just going to show you where it is currently. So if you're at the end of the day, right, it's just going to, it'll just show you the most recent lines, okay? But again, I have it showing all the unfinished business here, and you can see, the top of this bar, that's your unfinished business. Now, again, the way you really want to be applying it, the way it was sort of meant to be applied was when you go up to a fresh level, not necessarily every time you say you have it, right? That it's just because you have it in a bar doesn't necessarily mean anything, right? It's got to come at, a swing high or swing low, but it's one of those things that people sort of read about and they get enamored with it, and they think that that's this hidden way of reading the market. So like here, right, unfinished business, right, the market came back to, because you can have unfinished business in a bar and the next bar could come in, usually will just come in and finish it. What you want is you want the space, right? You want space between the bars for the market to come back to. You don't want to have here unfinished business. Now it gets completed in the next bar right here, right? Which is often what happens, right? It completes it in the next bar here, right? What you want is you want to have space. That's why I say, look for it at swing highs and swing lows. Right here, you got unfinished business, trading below that unfinished business, came back up, finished that business, and then came back down. Now, the way it was explained to me years ago by traders that were using it for a long time, under different market conditions, right? Those were the days when we'd have, a 15-point range in the E-minis for the whole day, right? So they would, there was less volatility in the market. So they would be looking for, the unfinished business and then the market to come back to it within a half hour, maybe an hour max. But they're not looking to hold these levels for all day. They're just looking for the market to come in, complete that auction, and then continue its move, right? So you want to have space between. Now, if you draw the unfinished business here, just go under unfinished business. All right, if you take out the broken levels, because these levels are all broken, right? It's going to be a lot cleaner, but it's just going to show you the most recent one. So you gotta scroll to the end of your chart to find it. Okay, so like for example here, all of these lines would not be there. It will just show you the most recent ones. Obviously this market's closed, so I don't think it's going to show you anything. But let's see here if the E-minis come back up real quick. But it's kind of pointless to have every single broken level drawn on your chart. But if you're watching the market during the day, constantly monitoring it, then yeah, maybe you want to use it. But again, for me, I just don't I don't use it anymore. Okay, come on. It's taken a while. There's just so much data. Plus today, I think my kids are using the internet. It's a little bit slow. But again, when you're looking at unfinished business, right? Don't try to extrapolate it out for hours and hours, right? You're looking for the market to come back to that level and complete it, and you'll usually complete that level pretty quick, right? It'll usually happen in the next bar or two, right? So that's why when you're looking at like almost every bar here has come in the next bar and completed it. Honestly, just looking at it, maybe if I was on a 5-minute chart, it would look different. Okay, so you can see here E-minis, right? It's not showing anything because there's no current unfinished business that's sort of unresolved, right? But here, let's pull up the 5-minute chart on the bonds, just showing everything. But okay, here's one here, right? From 38.32, right? You got this unfinished business right down here, this red line. Okay, obviously it's there, still there. You'd have to, well, it's not going to show. It only shows it on the actual chart, so you'd have to draw that line. So as it drops off the chart, right? So you can see it showing here, right? But if I go there, it's gone. They're just going to show it on the most recent chart activity. So you can see here, right? This is the 5-minute chart in the bonds. So you don't really see, generally unfinished business gets resolved pretty quick, right? There's one here, 02. We came down in there, 03. So anyway, again, it's up to you if you want to use unfinished business or not. Market sweep detector. Now this is a new one that's in the Orderflows trader software. Okay, and what it does is shows areas where big traders sweep through several price levels in one trade. And again, you're probably not going to want to use it on a market like NASDAQ because it's volume related. Okay, so NASDAQ doesn't trade a lot of volume at price levels. It's a lot of ones and twos go through at a price level. So let me turn off the unfinished business of this chart first. Okay, so here, moving along, market sweep detector is turned on. It's set to 3. It's going to look for 3 sweep levels, and the sweep threshold is going to be set to 10. Now, just so you don't get confused, I'm going to turn off all this volume imbalance, stacked imbalance, and inverse imbalance, because the colors are green and red. Let me just clean up this chart here while we're waiting for that chart to come up. Turn off this volume imbalance. Turn off the unfinished business, and I'll turn this off. And I got now on here on the sweep, I'll set it to a slightly higher number. So that's 25. It's the bonds. So I don't know. Bonds, it's a little harder to see sweeps in there because there's just so much volume that goes through. Um, Gold. See, like, well, right. So like this is NASDAQ, okay? And you can see here, right? Using the sweep, market sweep function isn't going to be very effective because there's a lot of areas where it just skips through price levels, right? The market is, 27 bid at 28 or 27 bid at 27 and a half offer, right? And it just jumps through these levels, a lot of zeros in there. So, you're probably not, it's not going to be effective in a illiquid market like NASDAQ, okay? So here's the bonds. So like here's a sweep, right on that number. Big traders came in, swept right through the market. Obviously the market continued down. Here's a sweep right here, right? Boom, 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 as the market continued its sell-off, right? So the market is just hanging around here. A big trader came in, sell it down. It's trading 10, and he sweeps it down to 07, right? You can even see he turned it offer here, right? The 309. So he sold what was bid here at 9, the bid at 8, the bid at 7, and turned it offer at 7. So he probably sold about 500 contracts. Just sell me 500 here down to 07. Boom, filled. Here's a sweep. Here's a bullish sweep right here. There's another bullish sweep. You got a bearish sweep there. But really, you want to be paying attention to it more during the course of the trading day than at night, because at night you got less volume, so it's easier to sort of sweep through the market. Okay, so here's the E-minis. Let's see if there's any sweeping activity. Here's a sweep here. Here's a bullish sweep, but we couldn't continue, right? We closed down below it. Again, imagine you want to be getting short below the bearish sweep and long above the bullish sweep, but you want to be getting short immediately or long immediately. You don't want to say, well, there was a sweep here and now you're going to get long 5 minutes later. No, you're looking for that action to happen quick. And this trading a sweep, right? You want to take advantage of it quick, right? You're going to scalp it basically. You're not going to buy and hold for an hour or 2 hours, right? You see it, you're going to get involved, right? That's the whole point of trading a sweep is you see some big activity in the market and you gotta participate, right? You want the market to be going in your favor. Sweep here, right? Sweep, right? As the market's moving higher. The bearish sweep didn't do anything. You're seeing some bullish sweeps in there. And again, it depends on the market that you're trading. Again, I'm just showing you a 1-minute chart because that's where a lot of people sort of come into the trading environment and is looking at a 1-minute chart. Okay, this is a nice sweep here. This is a bullish sweep, but it couldn't even continue, right? It didn't even go any higher, couldn't even go above the sweep, right? You want the continuation. Now, sometimes sweeps are caused by stops. Stops get triggered in the market, and it just runs through. It fills the order. Okay, so that's it does pick up these stops. That's why sometimes you see stops or sweeps at highs of bars or lows of red bars, highs of green bars or lows of red bars. Ideally, you want the sweep to happen. Ideally, I don't want to say all the time, but in the middle of a bar, generally, I find it going to be more effective because like down here, it could just trigger a stop right in here. Whereas if you're selling in here, right, you broke the low here, big seller came in, moved it down, right? In the middle of this bar, it moves higher. Market weakness detector. It's another new feature of the Orderflows Trader software, and it measures, the weakness in the market, and it's designed to show it to you anytime weakness is detected. But again, you got to trade it in context of the market. Okay, you want to be selling weakness after market's rallied, right? And you want to be buying weakness after the market is sold off, right? You don't want to, for example, here, I'll show you a couple. So the market weakness shows up here. Where are we? I'll take off this. well, I'll leave that on. But market weakness, enable market weakness, set to sequence length of 3, but it's going to be blue or orange, right? So if it's a bullish market weakness, now I know that's kind of confusing. Bullish market weakness, what is that? Well, it's just telling you that as the move is going down, the move is weakening, okay, and it's just going to turn bullish. Or bearish is the market's been moving up, but the aggressive buying has been weakening, right? So it's going to be orange. I'm looking for blue or orange. Okay, so for example, here, right, here's orange. Now we had just sold off, right? Okay, well, do you really want to be getting short after the market's just had a nice sharp move down? Now here's another bearish market weakness. Now the market had recovered a bit, come back up, it's testing a level, and you're seeing the buying now, right? Weakening. Okay, that's why it's time to get bearish, right? Whereas here, right, we were already selling off, so you're already expecting bearish, not bearish, but you're expecting weakening buying coming in, right? Yeah, okay, well, we're selling off already. So it's going to be more effective to be buying it, or sorry, to be selling it after a pop higher, right? In this case, we're testing this recent swing high and you're seeing the weakness come in, right? And the market obviously goes down. But then again, the next bar, it's got to start breaking down, right? If you're getting short, right? You got no follow through in the next bar here. Technically, this is bullish, right? Based on the order flow that's happening in here. But we can't even close up near the high of the bar. We close a little bit off. Then obviously the next bar can't even take it out. So again, it's not about just buying and selling every time you see it. Let the market tell you that, yeah, we still have that continuing order flow, because what's happening in the market, right, is when you trade, right, you have your idea of what the market's doing, but you also have to have all the other traders out there also believing in what you're saying, right, in your sort of analysis, right? They sort of have to sort of come to the same conclusion. But if they don't, then you're not going to get that follow through order flow, right? And the last thing you want, right, you don't want to buy, then all of a sudden something bearish comes out, or people are still bearish in their thoughts, and then the market sells off, right? You want the market to start moving in that direction based on whatever, right? It doesn't have to be necessarily based on your analysis, but people have to have a bullish stance for the market, to continue back up. Let's see here, where I got a crude chart here. Okay, all right, we going up, we pull back, we start moving back up, bullish, right? Bullish market weakness, bullish market weakness. Sold off again. Do you want to be getting short after you just sold off, or after you just rally up a bit and you see the weakness coming here, this orange, right? This orange and this orange, right? You don't want to be just taking them willy-nilly blindly, right? But even in this case, the next bar doesn't even take out the low of this bar, right? It's well up inside. Whereas over here, the next bar starts trading lower. Those are the trades you want to take, right? Just not, oh, I got an orange arrow, I got to get short. No, you got to think, right? That's what being a trader is about, is putting the pieces of the puzzle together, right? You want to analyze what's happening in the market, right? And if it doesn't happen, then, no trade, right? Here's one, it started, I don't want to say it was coming off, but, the high of the day is right here. You got a bullish signal. It just went up, and unfortunately, this one would have stopped you out, right? And then it made that move. That's how it goes sometimes, right? There's just still a little bit of selling pressure left in this market to move it down. Look at bonds. Was there anything in the bonds? Go to the Friday session here. Here. This is actually the 4th. Right before the big sell-off here, right? We're just sort of hanging around, going sideways. We pop up a little bit, and then wham, we get slammed down. Now people say, well, it's a move down. Well, yeah, I like to look at this more as a move sideways based on the value area, which I'll get to in a bit. But again, try and take it in context here, right? Your low of the day is right here, right? You see the weakness at the low of the day, the selling weakness, right? Come in at the low of the day. What do you think? The market's going to go down? Well, it could. Then you see the next bar also exhibiting the weakness, right? And it goes up, right, a little bit. Um, you know, here's one. It didn't go anywhere. Let's see. I think that was it. Again, buying into the high of the day. Honestly, I'd rather be looking for these blue arrows at lows of the day or at swing lows, not the high of the day. So anyway, the next thing I'll talk about is the value area. And this was a big thing that I wanted to put in the software for many years. And honestly, I couldn't decide how I wanted to show up in there. And I just decided to put in the value area, basically just to highlight it in the bar, okay? Rather than drawing a little profile in the bar and showing the value area high, the value area low. That's been done by other people, and that's all well and good. Then people start get fixated on sort of, I'll call it formations of the order flow, or rather of the profile. I just find it's a little cleaner showing it as, here, right? So this area between, in this green bar, right, the value area is between 37.30 and 3/4 and 37.33 and 3/4. That's why it's gray here. Now you can adjust it, okay, in here. So say you don't want to use 70%, right? Most people use 70% because that's the one standard deviation, but you can, people say, well, it's really 68 point whatever, but 70 is fine. You could adjust it to 50%. Say you want to look for, depending on how you're trading, you want to look for areas where the volume is really compact, right? You could change it to 50%. I wouldn't really go above 70 because otherwise you're going to cover the whole bar eventually. And the next thing I'll talk about after that is the EVA, right? I have it enabled here, okay? And you probably wondered why on some charts you see, or some bars you see blue and red. Those are the EVAs. So there'd be a bearish EVA and a bullish EVA. Now, value area, right, is generally the point of control will appear in the value area, right? The point of control is the level in the bar with the most volume. Once in a while, it may actually appear outside of the value area. And, I've done some testing on it. Is that important or something? Because, why would the point of control appear outside the value area? That must mean something, right? Honestly, so far, I haven't really found anything conclusive really to be interested about on it. But, when you're looking at value, right, the value areas of a bar is not just in context of the bar, right? Oh yeah, you can see the value area low here, value area high. Is you start to use it in context of the previous bar, right? Just as you would if you're using volume profile and using the value area of the day, right? You can use it on a bar by bar context, and it's important, and I'll talk about it here. So for example, right, on this bar right here, okay, we open up outside of the previous value area. We trade back in, we reject it, we trade higher, okay? And that's important, right? Now, obviously, this red bar we opened in the previous bar's value area, then we trade away from it, okay, that's fine. Now, there's bars where, let me just find it here for you, where we open outside of the previous bar's value area and we come all the way through the value area, right? Again, these things don't always appear as often as you'd like to see them, but they're important things, and that's why we have the things like the value area on the chart, right? So when they do appear, you know how to take advantage of it. So here, right, we open up, right, the value area low of this red bar is here, right, 29. We open up at 28 and a half, 28 and 3/4, trade all the way up through the other side of the value area, and we keep going, right? Now that's a bit like an engulfing pattern, but we just continue in that direction, right? So you always want to be looking for things like that. And there's all sorts of different ways to use the value area. And, in our weekly sessions, I talk about these things, things you can be looking for in the value area, right? There's gaps in value area gaps, what that means. And I'll just tell you right now, usually when I see two gaps in a row, here's one gap, here's two gaps, we tend to come back in and try to close both of them. It's not like gap one, gap two, and just go higher. If you see three gaps, really you're going to be looking for a pullback at some point, right? Gap, pullback. It's not a gap there, but that's what you'd be looking for, right? That's the analysis that you want to start getting into. Now, the EVAs, right? There's bearish ones and bullish ones. The bullish ones are going to be blue. The bearish ones are going to be red. And again, you want to be trading it in context of the market, right? Whether you're looking at the bonds, right? Bullish EVA right here, right? Market went up. Bullish EVA right here after a move down. Here's a bearish EVA right here after a move up. You're seeing bearish signs, right? And again, it's based on the volume, right? Because it's looking at the volume of the bar of what's traded, right? We're at the high of the day, 2 bars later, bearish value area, right? That's why it's red. Right? The market sold off. Bullish one, but couldn't even go higher the next bar, just hung in there and traded lower. That's bonds, right? Let's take a look at something like crude, bearish EVA, right? As the market dropped down about 20 cents. Again, I'm just, here's one, but we couldn't go lower in the next bar or two, right? That's not what you want to take. Here's one, went lower than 2 bars later, and again from 30, a small move, nothing to get too excited about. Here's one right here. Look at this move. Move from 20, what is that? 23 down to 73. Right? Here's a bullish EVA, right? Finally popped higher, got higher, not the next bar, but 2 bars later. And it moved from, 70 up to 90, right? This was a bearish one, but we didn't go any lower here. Here's another bullish one, right? There's a bearish one right up here, okay? So, that's the whole concept of the expanded value areas, right? It analyzes the value areas and highlights to you the value